Good morning, and thank you for joining us for today's free webinar, Angel Funding, Think Like an Angel, with Sirk Roh, Chief Operating Officer at Early Growth Financial Services, and Deepak Gupta, Managing Director at Seedchange. My name is Jenna Cornell, and I will be your moderator this morning. This presentation will run about 40 minutes. If you have questions as we go through the presentation, please feel free to enter them in the question field or tweet them mentioning at earlygrowthfs and Deepak S. Gupta 500 using the hashtag InsideAngels. We will answer questions as they come, and we'll have a Q&A at the end. If we run out of time, we'll follow up with an email after the presentation to make sure all of your questions have been answered. A video for this presentation will be available on YouTube following the presentation, and the slides will be available on SlideShare. Sirk and Deepak have a lot to cover today, and we want to make sure we save enough time to answer your individual questions. So let's get going. Good morning, Sirk and Deepak.
Jenna, thank you for the introduction. Appreciate it. Again, my name is Deepak Gupta. I'm Managing Director at Seedchange. I'm also a mentor at 500 Startup and Vegas Tech Fund. I look at early stage companies trying to raise seed funding, and these companies could be raising money anything from 250K up to 1.5 million.
Thank you, Jenna. This is Sirk Roh, and I'm Chief Operating Officer at Early Growth Financial Services, and we provide financial and accounting outsource services typically to small and startup companies. We have 350 clients across the country, and many of them are at the stage where you guys are at, which is either at looking at seed financing or after they have raised a seed or Series A financing.
So what's an angel? Well, we talk about angel funding, and we talk about trying to raise money from VCs, but what is an angel? Angel usually they're well off, obviously, and they're either from tech and finance. That's usually the case. These guys are very high net worth individuals. They could be located anywhere in the world, but primarily locals better, tech hubs or New York. They're well educated, part-time investors, and typically they see about 50 to 250 startups a year, and usually they're members of angel groups. Now these angels can diversify in terms of, okay, they might be going after real estate, they might be going after a lot of things, but for them, this is not a hobby. They're actually looking for good investment opportunities. So what kind of companies do angels invest in? Again, they're generally seed early stage companies, and it's a very big, diverse group. So from technology, clean tech, healthcare, fintech, you name it. And the biggest thing they're looking for is trying to figure out how to solve a problem. And of course, they're looking at the team, they're looking at IP, but I mean, they're looking for a really cool idea that's addressing a big white space.
Deepak, can you also just talk a little bit about the stage of companies that these investors would typically look in terms of product development or revenue traction?
Absolutely, sir. These companies generally are in terms of they have an idea, but I think traction is very important. And we're not talking about revenue, but more from a user growth. I think angels want to see something month over month growth rate and how that's been going. Unfortunately, to start a company, it might be very easy to get the idea together, but to have it funded and to have something to show traction, I think a lot of companies are having problems doing that. So from angel investing, they just want to make sure the idea has been fleshed out and there's some kind of traction. So how do entrepreneurs connect with angels? I mean, this alone is a full-time job. We're talking about long days, and this could take anywhere from 4 to 6 months, even longer. And I think the goal around this is you need to rely on your network, especially if you're new to Silicon Valley or you're not in Silicon Valley. I think to actually try to find angel investors, you need to know friends of friends through LinkedIn or whatever other means, trying to see, can I get these introductions? Obviously, you have to be very persistent and you'll get tons of no's. So you have to have really good communication skills. And the idea is you need to get this, whatever you're trying to sell, within 60 seconds to 2 minutes max. Just get the idea across to an angel investor and get them to actually listen more to you. The objective is, of course, getting introduction, but to how many? It could take a while, especially 4 to 6 months. So again, you need to at least talk to 100 and 250 investors, and then hopefully you get to meet at least 50 to 100 of them. And from there, hopefully you'll have follow-up calls with certain number, and then diligence process. I mean, diligence process is something that's ongoing even with the first meet, but hopefully a deep diligence is going with 25 to 50 investors. And hopefully we get some checks anywhere from 10K or 50K from 8 to 15 investors.
You can tell by looking at these numbers that obviously this is a pretty big effort. And as Deepak mentioned, you really have to be going out and talking to as many people as you can. And so it's your network, it is your partners that you've been working with, your lawyers that you've used, bankers, other service providers that you're working with. Anyone and everyone should be sources of just an ask of, do you know people who I might be able to speak with? Because you just have to be out there on the street at all times, and this needs to be a full-time job. And obviously, it goes without saying that, and Deepak is too modest to do it himself, but Deepak and his company, they have a network of angel investors across the world geographically. That he would be and he would be obviously a great source for leads to angel investors.
Thank you, sir. Appreciate that.
And Deepak, we have a question from the audience. David is wondering, I understand that VCs are looking for returns of 10 times or more. Is the return range for angels 2, 3, 5 times, or is it a case by case?
No, fortunately, it's the same numbers. I mean, angels are also looking for a 10x, and the reason they're looking for that high, 5 to 10x, is because end of the day, angel investing is also a risky investment. 9 out of 10 companies that you're going to invest in are not going to be around. And they know with the Series A or Series B, a lot of the investments you're going into, you might not even have that much of a stake a couple of series down the road. So therefore, angel investors are definitely looking for even higher returns compared to VCs, but they try to stay in line.
Perfect, thank you.
Okay, so what kind of questions will Angel ask? And this is across the board. This is even VCs. I mean, the first thing they look for is the product. What is your business about? And why will people use your product? I mean, these are very simple questions, but this is something that an entrepreneur needs to articulate, again, in the first 1 minute. And then the second thing, before you tell about your team and all that good stuff, is how do you make money? But more importantly, how is the investor going to make money? I mean, to keep these guys, um, I guess, in line with what you're trying to do and get you a check, they need to know, all right, does this guy know what he's talking about, A? And if I give him a check, what my returns look like? And that's very important to get that across in the first minute or 2 minutes. Second thing, of course, the market. How big's the market? And angels are going to find out who are your competitors. They'll look at distribution. Again, have you talked to your customers? So this is going back to that traction point. You might have a great idea, but we don't want to see stuff in beta. I mean, it's great you're testing out with 10 users or 15 users, but we want this product to be out there in a couple of months traction, again, month over month. How's that going? Finally, it does come down to the team, because there might be some really bad ideas, but if the team can execute, that's great. I mean, that's all we need to know. And then again, it comes down to traction. What have you shown me the past 3 months, 6 months? And whatever that you have projected, have you actually hit those numbers? And then who's on your team or who's not? You know, what are you missing? Sure, you're using engineers from, through Odesk or whatever. What's your goal? What are you trying to get in terms of team? Um, Now, again, this is heart of the product, but the risk. What is the biggest problem that you're trying to solve? Is there technology, IP behind it? And then whatever money you're trying to ask for, make sure you understand it should be for anywhere 12 to 18 months. Let's say 18 months you're thinking about raising a Series A. So within 12 months, you're going to start doing some fundraising. So you need to make sure that you have certain milestones that you have defined, and whatever financial projections, and I understand it's like kind of, you know, trying to figure out which way the wind is blowing, and you're trying to project, okay, this is my market size, this is a percentage I'm going to take. But even those kind of funding, financial projections, excuse me, you need to make sure that you can justify them and you can back them up based on your market size.
There's probably a lot of other points to cover, in this as well. They're going to want to know things like, what kind of a commitment have the founders shown, right? How long have you been doing this? How long have you been going with, either initially you're self-funded, or how much money have you raised from friends and family? Really, how much commitment have you shown to what you're trying to do, and that will go a long ways towards the investors feeling comfortable that they're putting money to a good cause. And I also want to reiterate what Deepak said about on the funding side and the justification and use of funds. The milestones, thinking about the milestones along the way and the milestones that you have to hit, and giving yourself fudge factors so that you hit those milestones. Because as we all know, the valuation of companies does not go in a linear fashion or even a curve, right? There are big step functions in terms of valuation increases, and those step functions, the big increases in valuations, happen upon hitting milestones, right? Whether it's first customer, whether it's product completion, whether it's 100 million eyeballs, whatever it is, those types of milestones make a big impact. And so you should be thinking about the funding required and the milestones that you're going to hit with that funding, so that when you go to that next round of financing, in this case a Series A financing, now you've got a justification for a big increase in valuation, so that the seed investors now see that 5 to 10x return in valuations from their initial investment. And it doesn't stop there either. I mean, you got to be thinking about that all along the way as you go from Series A to Series B. So when you're looking at raising Series A, you need to be looking at what milestones are you going to be hitting with that financing that you're asking for.
No, and that's a great point. Along those lines, sometimes I don't ask companies, usually maybe you're a serial entrepreneur or you've gotten money from friends and family, but what I do find out is what's the burn rate currently, and how many months can you last? Let's say you don't raise any money right now or in the next 6 months. Can you survive without raising any money? So whenever you decide to go out there and start, justify your fundraising, you need to make sure you have at least 6 to 12 months of cash or burn rate that you can start and say, okay, the past 3 months or 4 months, this is what my traction looks like. But in the next 6 to 12 months, I plan to do A, B, and C. But if I don't raise any money right now, I can still survive for the next 6 months. From an angel investor, that's really important, because they're thinking, okay, this guy can control his burn. He's not desperate for money right now, but he's talking to me at the right point in raising this seed fund. So this is another thing now that angels don't ask, and I wish they did. And this is a way you can actually differentiate if an angel is a good investor or not. Because if he's comfortable enough, if not in the first meeting, second or third meeting, then you know, all right, I'd love to get his money and try to understand, you know, what other angle he's coming from. So the obvious questions are obviously, do the founders like each other? Every company that goes out for angel investings, angels want to see if there are two co-founders, especially if one guy decides he doesn't want to do it anymore. The other guy can take over and actually run with it. Second thing is, I'm about to write you a check for 100,000 or whatever the money is. Do I trust you? And the most important thing, this is very important to me, can you sell your product? It's not just your product, your company, your idea. Can you sell, period? I mean, the idea is you're meeting me, you're taking, you know, my time out of my busy schedule. Can you get your thought across? Can you sell this? And then the other stuff is, how are you going about building your team? Can me, the angel, and you work together in trying to make sure we're hitting certain milestones, and then making sure we get you to a Series A? And then who else are you talking to? I mean, am I the only one? If I give you the money and you're trying to raise $500,000, you know, for me, that's a big risk. And finally, competition. You know, they talk about competition initially, but back of our heads, we're always wondering, all right, can Google or Yahoo or big players, small players, other startups, can they come out and just take you out, period? So as an entrepreneur, you need to make sure you have answers to all these questions, and you can actually talk about competition as well.
And a lot of this, you're going to get a feel as you're talking to investors. But the more and more you pitch, the more and more you'll feel comfortable, and the more you'll actually be able to, and you should be striving to try to answer these questions, you know, almost subliminally as you're doing the presentations and as you're having these meetings with investors.
So what are some non-rational criteria that entrepreneurs actually, I mean, angel investors might, you know, go into a company, a startup? Um, you know, for example, founders, do they identify with you? And meaning, is there some kind of relationship, or can they say, hey, when I was that age, I could be doing this or whatever? So it's some kind of a chemistry, for lack of a better word. Then maybe you went to the same university that I did, or maybe you had the same experience, you know, or whatever. So they want to make that connection with the founder. Same thing with the product. They want to see, oh man, this is so cool. I'd love to get some money in this idea. Same thing. Is there some kind of a personal pain? You know, it's like, for example, you know, I have to find traffic every day coming to work. This app will help me avoid traffic or whatever. So that kind of a connection, an angel would be like, oh, I need to put money into this. Finally, the market, whether it's personal experience or interest in whatever, travel or whatever, there could be a connection there as well. So finally, how do angels and entrepreneurs actually make a decision? And this decision can vary. On this slide, I've only showed 6 meetings. And again, the time could be anywhere from 4 to 6 months. And you know, some meetings are longer, some meetings are shorter. I know meetings, you know, in the first or second meeting, the angel investor gets so excited. He's like, here's my check. I want to get in right now. Having said that, you know, some could be 12 meetings, but you can see an average of first or second meeting what the interest is, and if this is going to go any further. Finally, the last couple of meetings, they'll talk about the terms. You know, does it make sense to invest? And they're just negotiating terms at that point. So again, this can vary. Finally, what's the decision-making process that the angels are going through in actually trying to decide whether they want to invest or not? And this is great. I mean, this is you go through a lot of pitches, and you're pitching to tons of people, whether it's at different meetups or whatever. But that elevator pitch is probably the most important. The first couple of minutes, people get the idea, people get the overview. Second then is a pitch deck, and we'll go through the pitch deck in the later slide. The third is then they're trying to address the founders. They're trying to figure out, what kind of skills do they have? Are they persistent? And then again, domain expertise. Finally, they're going through market and product, and they're trying to understand, all right, does this market make sense to me? What's the competition like? And then again, the product. Is this product something that people would be getting excited about? Along those lines, they keep continuing, and again, the tech team, they're trying to understand that. They're trying to understand, get a better assessments of use of funds. What are the milestones? What are the growth plans? And then what kind of deals are they getting? The terms for the other investors, and how much they want to get, and what's the percentage they're going to get based on the money or the check they're going to write. And finally, the least favorite is the legal stuff. They want to understand, all right, what's the paperwork, what's the formation, what's the stock. So that's basically a process a good angel would go through in trying to fund a company.
And I'll add a couple more points here on this, especially on the financial side, just because that's the area near and dear to my heart. But the more thorough that we can be in presenting the information and having thought through all the issues really, and what can happen, obviously the better off we're going to be in terms of confidence and feeling that having the investors feel that we really know what we're doing. And so to that point, there's when again looking at the financials, understanding the use of funds, understanding the milestones and the growth plan. But really, if you have to look at it from two perspectives, if at all possible, prior to talking with investors, you should do a tops down financial plan where you kind of take a look at the market size, the total market, or the total available market, the TAM. Whittle that down to a serviceable market, and then what percentage you're going to take from that, and you can build up a revenue plan that way. But then you also absolutely should be doing a bottoms-up plan that says, okay, well, based upon trying to hit these revenue milestones, I need to put together this kind of a plan. I need to put together this kind of headcount planning, advertising, marketing, spend, engineering efforts, and knowing what all those numbers are going to look like is going to really, really help you portray a sense of confidence and knowledge about what you're doing that is going to be well received by investors.
Exactly. As an entrepreneur, you want to make sure you're as well prepared going into this, and you understand the mind frame of an angel investor and what they're looking for. Preparation's the key, and the second thing is persistent. I mean, some of these guys don't have time, and no one will come out if they even say no to you. It's not that they're saying no to the deal, but maybe they can make some other introductions to other angels who might be interested in this. I tell all my entrepreneurs, you guys should have a list in which you've talked to everybody, and whether they've said yes or no, and once a month, just give them an update. Yeah, let them know how things have been so far. What has been the failures? What have been the successes? What are you looking for? Can you make any introduction? I think all of that is key in terms of just keeping all the angel investors in the process and saying, okay, who else can I share this deal with?
So you can see what what level of effort it's going to take when you kind of go back a couple of slides and you say, okay, well, I'm talking about having anywhere from 2 to 10 meetings with each investor. I'm trying to talk with 20 to 25 investors at a time, and Deepak talks about the persistence. and keeping at it and being able to juggle all the meetings that you're doing, the communications that you've had, the information you've shared with all the different investors at different stages, and it really speaks to the commitment not only you have about the product and about what you're trying to do, but about the actual fundraising efforts.
We have a couple of questions from the audience, if we don't mind answering them before we move on. If we're doing due diligence with 25 investors, that adds up very quickly. Is there any way to make it more efficient while still building strong relationships? How would an angel investor react to prepared documents for the decision-making process?
Great question. One thing is I mean, it should be pretty standardized what most angel investors are looking for. So the 90% of the information that they're going to ask, you should probably already have that in some kind of a, you know, Dropbox or box or whatever you like to use. So it's more of saying, okay, here's my information, here's the video, here's everything I have together that that you can find more information about me, uh, and continuing on that relationship. So for an entrepreneur, again, this is a full-time job of fundraising, and that's very hard to do because you're also, trying to run your own business, and that's why a co-founder and a team would definitely help in this process. Uh, that's the first question. The latter question, can you repeat that again, Jenna?
Um, so just how can you build a strong relationship more efficiently um, with each of
Right.
these investors?
Uh, Great question there too. Yeah, so that part of it is more about, it depends from angel investor to angel investors. Some people like to be, once a week check-in or whatever, but the relationship just, you have to assess each individual and see what they want to see and how they want to go about it. But I think that generally speaking, that once a month email providing those updates are very helpful to angel investors, even after they've gotten your money. Because, the biggest threat from angel investors are, once a entrepreneur gets my money, I never hear from them. And it's like 6 months, 12 months, and next thing I know, they're trying to raise and they're trying to email me or call me. So that relationship, I mean, it has to be looked from a long-term perspective. It's not just raising money, here you go, but even after that, just keep them, that once a month email or once a month call or whatever the angel investor likes. I think it'll be helpful for both of you guys.
Awesome, thank you. And then, Sirk, the next question is for you. What is the fine line between being conservative versus shooting for the moon in your sales and revenue projections?
Well, you know what? There is a fine line, obviously. The investors need to see obviously a ramp that makes sense for them from an investment standpoint. They need to get excited about it, right? They need to be excited about not only the product and the team and all that, but they absolutely need to be excited about the revenue projections. So, if I were to if I were to say, okay, lean one way or the other, I would say you do need to be somewhat aggressive to at least pique the interest. Now, obviously, you have to have backing for that, right? And that's kind of where I say that you kind of have to start from this tops down. You have to look at kind of what your serviceable market is, and the niche that you're going to have within that market. And then really hone it down. And so, when you come up with these projections and you say, I'm going to start with 1% of the market in the first year, and it's going to increase to 2% or 3% in the following 6 months, then there's at least there is a logic and a thought process behind it where you can actually talk about the assumptions instead of the numbers itself. You can't obviously pull numbers just out of the air and say, hey, listen, I'm going after $1 billion market and I'm going to get 10% of that, so this is $100 million company. Obviously, you can't do that. But at the same time, and I know that you want to you don't want to be so pie in the sky that these are unreasonable expectations. And first of all, investors are going to see through that, and secondly, it's only going to be a short-term gain because at some point they're going to call you on it, right? And you don't want to have that discussion of why you can't even come close to the projections that you laid out, when you first introduced the idea to investors. So it is that fine line, but you absolutely have to pique the interest of investors initially, and you're going to have to show a significant market size and ability to get to that market in order to get the interest of the investors.
Yeah, sure. Along those lines, really quick, and this is done a lot once you reach Series A, Series B, and further. But even at seed stage, whatever numbers you're presented, chances are that if he's a good investor, he's going to cut that by 50%. And he's going to try to understand, if I cut this by 50%, what will the burn look like, and how long would this company last? I think the burn and the way the money is being used are very important to the investor, whatever series you're going after. So as an entrepreneur, you always need to remember that you have to develop a company in a sense that it could be a standalone model. You need to make sure that, am I having cash? Am I just doing a growth equity, for lack of a better word? It's like I have something that works, here's my margins, and I just need to grow that one idea on one vertical along, whether it's market or whatever, just continually grow that idea. So again, coming back to angel investors, he needs to see that one vertical and say, okay, I understand what the cash flow looks like, and I understand how much cash is being generated by this single vertical. Now all I need to do is provide them a $500,000 or 750 or whatever the number is, and based on market adoption, he can take this simple idea and grow it, and hopefully conserve cash in the long run.
Great, thank you. And then one
Great
more
points, Deepak.
question. Should the legal part of the process be brought in earlier, especially for the regulatory threat?
Uh, yes, for legal part, even though it's at the end, I think that was just trying to understand from the numbers and trying to understand, all right, does the deal make sense? But technically, that should be one of the first questions, meaning, are you a Delaware C corp or are you not? And what kind of money you're trying to raise. So that might go in the initial, first or second meeting. But having said that, um, this is probably at the end, just making sure you're crossing the T's and dotting the I's.
Perfect. And then how much will investors allow the management team to be paid?
So, yeah, this is it definitely depends company to company. If you're 22, 23, and I'm about to write you a check for $1 million, I want to make sure you're not going to go buy two Ferraris or something. Having said that, we understand, so far you've been probably living no salary, and you've been going, most of the money from friends and family or whatever. So you could put X percentage towards salary, and you can say, my burn's going to be whatever, 20K, 25K per month, which I'm going to use 15K or 20K in, marketing, engineering costs or whatever, and the 5K on salaries or whatever the number is. The idea is, I think it's good to be very open and upfront about salary and that expectations, especially to an angel investor. Um, because end of the day, I mean, again, these guys are taking a big risk, and they want to make sure you're spending the money wisely.
Having said that, there's also the dynamic of, they also don't want to see entrepreneurs starving, right? They know that there's already been a big commitment. They want to see that commitment. They know that some of the money is going to be used to actually start paying people And so, we shouldn't shy away from it. We shouldn't be saying, hey, we're going to continue to, to do this with no salary. So pay yourself a reasonable salary, but be open and honest about it. Put that in the uses of funds analysis so that they see kind of what it's going to look like. And so it should be part of an overall picture of spending, and not just necessarily just the one thing that you or the investors focus on.
Great, thank
Yeah, I've seen CEOs, take nothing because they're well off, and maybe they've done it before, and they want to put all the money towards marketing or to hiring engineers or what have you. And I've also seen entrepreneurs, founders, pay themselves, $8,000 to $10,000 a month with seed financing. So it just kind of depends on where it's at, how much money is already being produced, how much of the money that you're asking from investors is going towards funding of the operations versus growth, how much revenue traction you have. So there's a lot of factors at play there. In the end, it's going to be kind of an overall, jigsaw puzzle that's being put together, that the investors are going to see the entire puzzle after it's been put together, as opposed to individual pieces.
Finally, this is probably one of my favorite slides because I think this slide will actually get the message across. Are we having some background noise? I'm not sure. Can anyone else hear that? Hello?
No,
Hello?
I think it's okay.
Okay, sounds good.
Yep.
So the funding pitch is probably the most important, and the slide deck. And the slide deck is important because we need to go in and actually tell a story. The first thing you need to do, whatever business, whatever model you have, is to tell a story, and that story should be no more than 30 seconds to a minute. The idea behind the story is you need to get the investor excited about your product and emotionally connect with you as well as the product. So this is very important. The second slide should be more about the problem. What is the problem you're trying to solve? And then the solution. What's the solution? Then jump right in. Tell me what the market size is. How big is the market? And then finally, how are you going to make money? And this slide can either go above market size or after, but to an investor, he definitely wants to know, all right, what's the market and how are you going to make money? Finally, competition, and they need to know, okay, are you the only one in the field? Who else is out there? And finally, the IP and the team. I mean, team is last in this slide, but some investors like to see the team earlier up. But generally speaking, this 10 slides, 10 to 12 slides is the way 90% of angel investors like to see a slide deck. If you have more information, just put it in the appendix, whether it's financials, whatever else you have. You can throw things in the appendix. So if an angel investor wants to know more, you can go after your slides are done. And finally, obviously, please don't read from the slides.
And the goal of this pitch deck and is to really just get pique the interest, right? And so you don't have to put 100% or even close to the information that you want to share on the slides. They should just be bullet points that you can talk to when you meet with them, but just enough to pique interest and just enough to whet their appetites, so that they want to speak with you and want to meet with you. The other thing that I would say is that you got to get comfortable, right? You got to get comfortable with the pitch, and the way that you do that is you practice and you practice and you practice. Do it in front of the mirror, do it in front of friends, do it in front of family, do it in front of your accountant. Just take every opportunity to practice as much as you can, especially if you're having more than one person there, because that's kind of when you're going to really hone the presentation. That's when you're going to get to that comfort level where some of those questions, the questions that the investors don't ask, will actually get answered. I think I was reading in Art of the Start by Guy Kawasaki, which I heartily recommend every one of you to read if you haven't done so already. He mentions that it takes 25 to 30 times of presenting one specific presentation, before you become really, really comfortable with it. And so, if you can do that before you actually meet with investors for the first time, then you'll go a long way towards making a good first impression.
Finally, this question on valuation is always asked by the entrepreneur. It's like, okay, I have this many users. What should my valuation be? And it's definitely geographically, I guess, dependent, as well as on traction. So the idea is, geographically, if you're in the Bay Area, the valuations, unfortunately, here are a little bit too high, even based on whatever traction. But usually speaking, if you're starting out and you have 100 to 1,000 users, or 500 to 1,000, 3 million valuation is generally pretty norm. But I've seen numbers go to 4, 5, even 8 million valuation. I mean, if you look at YC Combinator companies, they're a little bit high. Having said that, if you're in Chicago or New York, the comps there are different, and therefore, whatever valuations are out here, you can't really justify them in Chicago.
And Deepak, can you also speak to that last question, which is who determines the valuations, right? Do the entrepreneurs get to ask, or do the investors tell?
Yeah, this is a question that goes back and forth, but usually entrepreneurs kind of do put the first, I guess, stake in the game and say, I think it's based on this, and here are my comps, or here's my understanding of the market. Therefore, I'm going to ask this. But at the end of the day, the investors, especially angel investors, kind of control this. You could be asking for an $8 million valuation, but if an angel investor said, here's a check for 750K at 5 million valuation, then it's your decision whether you take it or not. But if you have multiple angel investors that you're talking to, it kind of helps, because you know what you're asking for, and you're saying, here it is, and then you can negotiate with each investor on what they're comfortable with.
Thanks, Deepak.
Well, guys, that's it. Again, here's my email address, and I'm on Twitter as well. So I'd love to hear from you guys, and you can ask me any question. Thank you.
If anyone has any final questions they would like to enter in the question field, you're more than welcome to do so now. Any additional questions regarding the webinar, the information covered, feel free to reach out to Deepak or Sirk directly. Their contact information, as well as a link to the presentation and the slides, will be emailed to you tomorrow. So any follow-up questions, feel free to email us directly. And it looks like we do have a couple of questions from the audience coming in. So if your company is app-based, obviously there can be a significant startup cost involved, which is one reason why you're raising money. Is there any way to show traction without the actual business or product being launched?
Unfortunately, no, because app cost is considered basically a sunk cost. That cost, I compare apps in 2014 to .com in 1999. There are just so many of them, and there's so many websites in the late 90s that were going after, whatever whatever idea. And the app market, unfortunately, is in the same kind of, I guess, cycle. So I think once your app is live, you still need to hit the traction, and you need to address this. Okay, this app is going to be around, and won't be another app.
Yeah, if and obviously it depends case by case. I mean, if you're a serial entrepreneur, if you've already created several apps that have sold, lots and have had successful exits, obviously that says one thing. If you're kind of starting out and you're thinking of an app and you know you need to develop it, this is kind of where I would say that initial commitment, right? The founder commitment, both in terms of time and as well as financial resources, is critical to show to investors. So it's about, how long will you go and work on it yourself or with another founding team member? How much money will you have raised from friends and family? Which shows the commitment that you have as well as the commitment that your friends and family have in you, the confidence they have in you to be able to pull this off. So without that, I think it's going to be tough sledding.
Perfect. And the next question from the audience is, why do valuations differ depending on geographical location?
I think angel investors like to invest locally. So therefore, if you have angel investors in Chicago, again, they're used to whatever valuation they've seen locally. So again, it's more on the comps of that local region and what they have invested previously that they're basing your idea and your app on, or your product, excuse me.
Yeah, and I think this is just the classic, supply and demand. You could ask the same thing about housing or hotel rooms or anything like that. It's about how many investors are there looking for deals, versus how many companies and entrepreneurs are there locally, who are seeking out investors, and there's always an equilibrium. And the pricing or general comps in specific regions is typically dependent on that. But that is also another reason why you're seeing, I think you are starting to see, and Deepak could probably speak to this as well, and one of the reasons why he's been so successful as a global conduit for investors is that, more and more there is getting it to be a little bit more sophistication, and Deepak has access to investors from different, regions that, and different countries even, that are interested in investing in companies in Silicon Valley or in Chicago or New York or in Austin.
Yeah, one of my friends actually made a quote which I love. He said the next Silicon Valley is going to be on the internet. So in terms of the playing field and the comps, it's basically, the idea is the investor could be anywhere in the world, but if he's you know investing in companies in Silicon Valley, which is going against the grain of local investing, he is going to look for comps which are similar what he can expect in the valley to any other region.
Great. It looks like that is all of our questions. If anyone else has any questions, feel free to email them, either responding to uh, the automatic email that goes out through the webinar, or to Sirk or Deepak directly. And thank you again for joining us today. We hope you got a lot of valuable information from this webinar, and it will all be available to you on YouTube and on SlideShare this afternoon.
Thank you all for your time, everyone, and thank you, Jenna, for moderating.
Likewise, thank you, Jenna, and thank you, sir. Appreciate it.
Thank you, Deepak. Take care, everyone.
Take care. Bye.